Thanks, Noah. Good morning, everybody. It's great to see the big turnout today, both in person and listening and watching remotely. We've been looking forward to this day for a while because, A, we love talking about Athene, and B, we want to convey how excited we are with the merger and complete alignment with Apollo and the growth and profitability prospects for Athene going forward. We started the company in July of 2009, right after the Lehman crisis. And we took advantage of that crisis then by locking in cheap assets and liabilities and a profit continuation that we benefited from for many, many years after that. Since then, we have a track record of taking advantage of crises. And we have no doubt with our capital position and our opportunistic mindset that we'll take advantage of future crises as well. Athene's had remarkable growth since its inception, spurred by strategic M&A and block reinsurance transactions, as well as significant organic growth. The highlight of our M&A activity was the October 2013 Aviva USA acquisition, whereby Athene, a $15 billion invested asset company, became a $60 billion invested asset company, as well as what came along with that was the infrastructure that allowed Athene to be a major player in the retail market. Ratings improvement as well have significantly helped our organic business. And as I stand here today, our growth prospects have never been better. We expect to double our invested assets over the next 5 years. We're in the right demographic. We're targeting people planning for the retirement or in retirement. Corporations no longer take care of retirees, as evidenced by the shift away from defined benefit plans to defined contribution plans. People need yield. Athene offers retirement savings products that help individual retirees manage their retirement needs and corporations fund their retirement needs. In the 80s and 90s, before Athene, I worked 20 years for SunAmerica, which advertised itself and labeled itself as the retirement savings specialist. The crisis of people not having enough savings for retirement was a crisis over 30 years ago, and it's even worse today. Over 50% of all Americans are worried about this. Again, we are targeting the right demographic. In the last 10 years, the life insurance industry has returned significant amounts of capital to shareholders, and because of that, the industry needs capital. You can see almost 90% of the industry's excess capital has been returned via buybacks. And I think the Autonomous Research quote is appropriate. Because of that, the industry is unprepared for future crises. Athene, however, has the capital that they need. And this deficit of excess capital continued to accelerate through the first quarter. You can see 10 of the 13 peer companies here reduced their estimated excess capital in the first quarter. As the slide said, private sources are providing the capital backstop for retirees. And Apollo and Athene have been leading the charge, providing 36% of all capital raised by the industry in the last 12 years. Just like Apollo does with Athene, alternative asset managers should view insurers as clients and invest in the equity of the companies for complete alignment. One of Athene's competitive edges has always been, and currently is, and will be in the future, capital. aided by Apollo's unparalleled ability to raise capital, Athene is very well capitalized. We have A-plus financial strength ratings across the board. We have $20 billion of regulatory capital, $3.3 billion of excess equity capital, and combined with unutilized leverage, financial leverage, and our third-party capital I'll talk about, we have $7.3 billion of capital to deploy. What does that buy us? Close to $100 billion of buying power. In the first few slides, I talked about the restructuring and the capital needs of the industry. We're going to put this to work at profitable transactions. As in the past, we're going to use this capital to provide solutions to the industry going forward. I've said it in the past, so I continue to say it. I think the company with the most capital and the appropriate opportunistic mindset in the long term is going to win, and we expect to be that company. By design, our business is very simple. Boiled down, it's make more on your assets than you pay in your liabilities. We generate inflows by offering a suite of principal-protected products, take the proceeds, and at inception, match the proceeds from the liabilities with a similar duration, similar weighted average life asset portfolio of almost all investment-grade fixed income assets, locking in a spread for the long term. And the result, when you apply appropriate leverage to it, is mid to high teens returns, far outdistancing others in the industry. Following along with our business model being very simple and straightforward is our balance sheet. You can see some of those are about $230 billion on the asset side, $230 billion on the liabilities and equity side. Almost all our assets are fixed income, 94%, 6% in alternatives, with some income generation additive there. And the liabilities are very predictable, persistent, low cost. I think Mike Downing will talk about it a little later. And we can invest with certainty behind those liabilities. So we're in the spread-based business, again. And we underwrite to an attractive net spread. Ballpark here with current numbers, we invest in this fixed income portfolio, that investment grade, that generates about 4.3% in yield. Cost of funds is about 3%, ballpark. 20 basis points of operating expenses gives you a net spread of about 110 basis points. But you can see how much more efficient and outperforming we are on the right side versus others. And those numbers lead to an ROE of mid-teens or higher, which more than 300 basis points better than others in the industry. The key to success in this industry is asset yield, targeting about 35 basis points of outperformance. In addition, we're not trying to hit grand slams and home runs here. These are singles and doubles on a regular basis. Be disciplined, stick to your knitting. You'll notice on the balance sheet page I talked about before, we only put on liabilities that we can invest with certainty behind. You're not going to see us in variable annuities and traditional life insurance unless we can get the returns we want, or long-term care, or property and casualty. We know what we do well, and we're going to keep doing it. We also treat all of our partners with a lot of transparency and disclosure. We pride ourselves on that. So whether the constituents are rating agencies, regulators, shareholders, policyholders, we treat them as partners. The more they know about us, the better for us and them. So I think the lawyers changed the title of this slide because I said Athene's team is the strongest in the industry, not one of the strongest, but I stick to that point. And so it's, I don't know if it's the dream team of all, but it's close. And so it's really proud of the management team. They've done a fantastic job. People on the page there, they have a great combination of both industry-specific experience as well as overall general financial services experience. And the results speak for themselves. So Apollo's been the perfect partner for Athene. We've been closely aligned from the beginning of Athene. And over the time, the 13 years Athene's been in business, Apollo has consistently increased its ownership stake in Athene. It was clear to me that the end game was always going to be one company, completely aligned, and more convinced that was the right decision now than ever. We're a better credit combined, we're a financial powerhouse combined. So now Apollo owns 100% of Athene, every single asset and liability on its books. Complete alignment comes with a lot of benefits, including more efficient rollouts of new products, which you're going to see and hear more about today. And I'm talking about state-of-the-art products that haven't been done before. Very excited about that. And full alignment allows for continued long-term outperformance. So, for the first time in Athene's history, Apollo's asset sourcing machine is outpacing Athene's funding machine. And that's a credit to Apollo building up their capabilities. And it's a great thing for the combined entity. Because now, Athene right-sizes its appetite for each one of Apollo's assets. It says we want this amount. The amount over and above Athene's appetite, Apollo then kicks in its syndication and third-party operations machine to find homes for those assets, all of which generate fees for the combined entity. And now the market is viewing Apollo and Athene as one company, completely aligned, and that's a very good thing. These four metrics that Athene outperforms on have been the case for quite some time, from our beginning. We actually were profitable the very first month we started in 2009. But on the outperformance metrics, look, starting with capital, regulatory capital to reserves, you can see significantly higher ratio than like-rated companies and higher-rated companies in the AA- category. Lower financial leverage, lower credit losses, and a far more efficient cost structure. As our ratings have improved to A+ over time, our organic premiums have soared, growing from $3 billion when we started our operations in 2014 to $37 billion over 7 years. Importantly, it's one thing to be in these various channels that we participate in. It's another thing to be number one in every channel that we're in, while producing stellar returns, which Athene does. Our philosophy is no volumes without appropriate returns. So we talked about our founding in a crisis, ability to take advantage of future crises, but we continue to price our products with the same, more or less, target spread, irrespective of the market backdrop. We target the same spread. We have regularly produced very profitable organic growth in different interest rate environments. And in fact, you can see at the bottom of the page on the normalized spread-related earnings, the actual dollars of income have exceeded our underwritten targeted spreads. We perform much better in a higher rate environment because of the presence of our floating rate assets that Marty and Martin will talk more about. And we perform better in a more volatile environment, given our excess capital position and our opportunistic mindset. While we price business to predictable spreads, our growth and profit is enhanced by third-party capital. In 2019, we completed the first sidecar in the retirement services business. It was originally intended to only fund M&A activity, but with investor demand, it has been expanded to also fund organic premiums. Instead of raising capital when the capital markets are open, but you don't have a specific thing to spend the money on, thereby excess capital being on your balance sheet and reducing ROEs, this is committed capital, ADIP, committed capital vehicle that is drawn only when we know there's something we're going to spend the money on, thereby much more capital efficient. The performance of ADIP 1 has been great, exceeding what we told investors, which sets us up very well once we finish up the deployment of ADIP 1 to have a successful ADIP 2 fundraise. Third-party capital just makes us more capital efficient, funds our growth, diversifies. It's a good thing all the way around. So let me put on my Chief Investment Officer hat for a second and talk about assets, which is where most of the value proposition in this business comes from. Outperforming on asset yields, which we've done, while having lower impairments, which we've done, is a very powerful combination in our business. Our $220 billion invested asset portfolio is high quality, diversified, and liquid. 94% of it is in fixed income, 6% in alternatives, and of the 94%, 95% of that is investment grade. It's resilient, high grade, stress tested. And we've outperformed our others on the asset side, not because we've taken more credit risk. We don't do that. We've taken some structure, some liquidity risk. We've also outperformed based on asset allocation. Our weighting to structured securities partly stems from how cheap they were when we started. We still find value in structured securities today, as Brett Lees will talk about a little later. So we've outperformed based on asset allocation. We also outperform based on our underwriting standards, that Scott Wiener will talk about in our commercial mortgage portfolio today. So manufacturing asset spread in a low spread world is the name of the game. The prices for liquid on-the-run CUSIPs, fixed income, have been bid up so much that there's very little alpha and yield left. To combat this, I know of no other company that has spent the time, money, and investment in people that Apollo has in private direct origination. And the results of these investments are compelling. Direct origination platforms consistently originate fixed income investment grade assets at more than 150 basis points wider spreads than in the broadly syndicated markets with the same ratings. That's a big part of the value proposition here. Talked about the areas of differentiation within our asset portfolio. You'll hear more about that today. Structured securities, our weightings there, commercial real estate, our underwriting processes there. And then 3, which we're going to talk about next, is our investment in our alternative portfolio, which is very downside protected, but still achieving more than double-digit returns. So Athene invests in alternatives that are strategic, downside protected, less volatile, and have collateral with fixed income cash flowing characteristics. We do not typically invest in funds with pure equity bets. More than half of our $11.5 billion alts portfolio is in Apollo fund investments. However, the fastest growing part of our alternatives allocation are strategic origination and retirement services platforms, which are almost half the portfolio now and growing, all part of our direct origination projects with Apollo. We target double-digit returns in our alternatives portfolio with less volatility than the equity markets and have achieved that. A real clear example of that was the first quarter of this year, when on an annualized basis, Athene's portfolio was up 17%, while the S&P was down 20%. That's significant outperformance. And that's been the history of this portfolio at Athene since we started. It will meet or slightly underperform when equity markets are doing very well, but significantly outperform when the equity markets are struggling. So in conclusion, just to summarize key characteristics of Athene's business, we have a simple and scalable spread business model. We match assets against the liabilities at the time the funding comes in and lock in a spread for long term. We generate low-cost, persistent funding, and Athene is one of the few companies in the industry with no legacy issues based on when we started after the financial crisis. We have a clean balance sheet. Every business we're in, we want to be in. We have leading, in each of our channels, organic growth capabilities. We're very well capitalized with a lot of excess capital to be opportunistic, a long history of very low credit defaults, and we're very well managed. Proud to say that, and prepared to go and are going on offense as we speak to take advantage of additional market dislocations.